Hi everybody, my name is Hai and I am an investor primarily focused on real estate investing, but I also put some money into the stock market as well. Here in this video, I'm going to be sharing with you which metric you should be focusing on when investing, whether it's cash flow or net worth. There's a ton of great information on this one, so make sure to hit the thumbs up. It really helps out the video get shared with other people who might find this information useful. And make sure to stay to the end. I'm going to be sharing with you how much money you actually need to invest so that you can retire. Okay, now let's get started. So why does cash flow or net worth even matter? So knowing your net worth or cash flow will help you identify which areas in your life you need to work on, whether it's expenses or debt payoff. And these are great benchmarks to track your financial progress. Cash flow will tell you how much money you're taking in as profits and ultimately how much money you'll have to spend in other areas of your life. So cash flow is thrown around in investing, particularly in real estate, and it's used to describe how profitable certain investments are. So personally for me, when I'm looking to buy a property to invest, one of the things I'm looking for is how much rent can that property generate for me. And I look at the properties around that neighborhood to see how much rent other houses are being rented for. And this gives me a good estimate on how much cash flow I can get out of that investment. I recently did a video on what I did to my investment property that I recently purchased, and I'll link that video up top so you guys can take a look at what I did to maximize the rent there. Net worth will capture all of your financial efforts in one place, and this is a great way to track how well you're doing financially. It's a little bit more mainstream in the sense that this is how we track how much wealth a person has, particularly the ultra rich. Take a look at Forbes 400, for example, or the 400 richest American list published by Forbes magazine. They utilizes the net worth of a person and rank them amongst each other. So currently the richest person title is held by Tesla CEO Elon Musk, whose net worth grew more than 580% and became $188 billion, surpassing Amazon's Jeff Bezos. This was mainly due to the crazy performance by the stock he held in his company Tesla. So knowing these metrics can help investors determine if they're on the right track, as well as help create achievable goals for them to hit along the way. First, to be able to compare the two, we need to define how do we figure out net worth and cash flow. And for net worth, we take your assets and we subtract it from all of your liabilities. So to understand this, we need to understand what is considered an asset and what is considered a liability. To make it simple, assets are things that you own and also makes you money. So things that are considered an assets include your checking and your savings account balances, your rental properties, your businesses, or your stocks, your bonds, your 401ks. So liability then is considered the total amount of money that you currently owe. And for the most of us, we have to borrow money to go to school for college tuition, we have to borrow money for our house in mortgages, and we have to borrow money to buy a car. So all of these are considered debts and are in the liability column. So looking at the net worth formula, asset minus liabilities, we can see that if you have too much liabilities, you can actually have a negative net worth. Typically we see this when people have access to credit spending, like a credit card, and they spend a ton of money without actually paying them off. They start accruing interest, and that interest will balloon and will surpass the amount of assets that they own, and they end up with a negative net worth. When used correctly, a credit card can be very beneficial. When used correctly, a credit card can increase your credit score. And then you can use that higher credit score to get a better mortgage rate on your rental property. And now you've added more items in your asset column. Credit cards will typically give you cash back as well, whether it's 1 to 5%. Over time, this money will accrue and it will be given back to you at the end. So to calculate your net worth, add up all of your liabilities, subtract anything that you owe on it. Assets like businesses and rental properties can quickly turn into a liability. And this is determined if it's making you money or is it costing you money to keep. There's a ton of factors to be weighed to determine if that liability is worth holding on to. One of the things to consider is how well that liability will perform in the future. A liability 1 year can quickly turn into an asset again in 3 or 5 years. Moving on to cash flow. To calculate cash flow, you just take your income and you subtract it from your expenses. and income is just the amount of money you're taking in. Cash flow then is a measure of how much money you're actually taking in and you could physically use for other things. In contrast, net worth is something that you can't spend right away. You would have to sell that asset before you have that money in your pocket to spend on other things. Some examples of incomes are rental property income, dividend stocks, or income generated by a business. Expense then is the amount of money that is leaving your pocket. Some examples of these are utility payments, mortgage payments, taxes, or management fees. Cash flow can be summarized as one word: profits. And profitability is what all businesses seek to achieve. The more profitable a company is, the more cash flow they generate month to month. So one of the most popular personal finance movement in the past decade has got to be FIRE. Financial independence, retire early. So the people who follow this principle try to achieve financial independence. That is, not relying on their 9-to-5 jobs for their basic necessities, but rather using their investments and the cash flow generated from that to fund their lifestyle. So on the journey of financial freedom, having enough cash flow to fund your lifestyle means you don't have to trade your time for money anymore. And you can use the time you freed up to do whatever you want, knowing that all of your personal expenses like home and food are covered. So now that we understand net worth and cash flow, which is better when tracking your investments? You as a new investor, I'm going to assume that you have a lot of time left in your future to continue to work and create income so that you don't actually need to rely on your investment for the cash flow to live off of. That is not to say that you shouldn't use the cash flow you're generating now. But if you do, know that you're really limiting yourself in the future by spending the money today. So do yourself a favor and don't touch that investment and allow it to snowball into the future so that when you need it, there will be plenty in there to cover all of your basic needs. Cash flow then is not the metric you want to focus on. It's good to use cash flow to determine if an investment property is worth your time into acquiring, or if one stock is better than the other based on their dividend. But you shouldn't gauge your progress on cash flow. Instead, use net worth. The amount of money you make doesn't make you wealthy. What makes you wealthy is how much you are saving and investing. Cash flow will give people the illusion that they're wealthy right now. So they'll suffer from what is called lifestyle creep. So this is when people start to treat themselves to things that they don't normally treat themselves to. And over time, their living expenses will also increase as their cash flow is increasing. So at the end of the day, you're not actually investing more as your cash flow increases. So my advice is to focus on a higher net worth and invest in things like real estate, stocks, and assets that will grow over time. So the great thing about real estate and stocks is that you don't have to pay taxes on the appreciation you get from them until you're ready to. If your metric were cash flow and you aim to maximize that, you'll end up paying more in taxes every single year because your income is higher. So eventually your net worth will be high enough so that you can start moving your assets around so that it can generate you the most cash flow. So when's a good time to start transitioning from net worth to cash flow? So for this, you need to know how much money you need to live off of. That is enough money to cover your living expense, your food, and any other expense that you might have over the month. So this number is called your financial freedom number, and it's different for everybody. So let's say your financial freedom number is $3,000 a month, and you want to collect that money from dividend producing stocks. These are company stocks that will pay their shareholders a portion of their profits in the form of dividend. So by and large, most companies will pay out every quarter or every 3 months. There are companies out there that will pay monthly dividends as well. So in this example of $3,000 a month, let's say you want to invest in VYM. This is Vanguard's High Dividend Yield Index Fund ETF that gives a 4.45 return annually. So using the formula on the screen, we can calculate how much money we need to invest in VYM to get a dividend return that will give us $3,000 a month. You'll need $808.988.76 in VYM to get $300 a month in dividend. Or if you invest in AT&T, a telecom company that gives a dividend of 7.13%, you'll only need to invest $504,908 to have all of your basic expenses paid for. And if you want to invest in real estate like I am, you'll just need to figure out how many units you'll need to generate $3,000 of cash flow every month. Using the cash flow equation, a good return on an investment property is around $200 a unit. So using that number, you'll need around 15 rental units to achieve financial independence. Well, thank you all for watching. Please hit the thumbs up if you haven't so already. Make sure to subscribe, and I'll see you in the next one.